Welcome to Investing Insights. I'm your host, Ivana Hampton. Exchange-traded funds can help you cut your tax bill. All funds must distribute capital gains from the stocks and bonds that they sell throughout the year. The gains can leave you stuck with unwanted taxes. ETFs and mutual funds differ when it comes to tax efficiency. It starts with how the investments are traded and how the transactions are treated. The differences can result in ETF investors owing less or nothing because ETFs can minimize their capital gains distributions. Joining me is Bryan Armour from Morningstar Research Services, the Director of ETF and Passive Strategies Research for North America, explains how ETFs beat mutual funds at the tax game. Welcome back to the podcast, Bryan.
Thanks for having me.
So ETFs are more tax-friendly than their mutual fund rivals. Why is that?
Yeah, so it comes down to how they're structured. So mutual fund, you can trade at the end of the day at net asset value, but only once a day. And ETFs, meanwhile, shareholders trade with one another on stock exchanges. And then authorized participants are the ones that get to trade directly with the fund and create or redeem more shares. And so that two-tiered approach, having the secondary market and the primary market, allows for easier handling of cash flows so that fund doesn't have to then buy or sell shares based on what people are trading on stock exchanges. They can only do it when authorized participants trade with the ETF. And on top of that, with the ETF, they tend to do it in kind, custom creation and redemption baskets. And so what that means is, like, instead of having to go out and buy the underlying stocks or bonds or selling the stocks or bonds, they can just get them from the market maker and then pass it back to them when they redeem. So there's no actually realization of capital gains.
And how does the way ETFs are traded limit the tax drag that affects mutual funds?
Yeah, so because of that process, they're not realizing capital gains, and they're also able to in kind redeem some stocks that are sitting on high capital gains and reduce their cost or raise their cost basis in those scenarios, which makes them much more tax efficient, because when they actually do end up selling, which is rare, then they're selling a smaller gain, and they can find other ways to take losses and offset that gain pretty easily. So very rarely do ETFs actually realize capital gains. And I ran some numbers for 2024, and U.S. equity ETFs, 7% had a capital gains distribution over 0%. And then 78% mutual funds did. So the difference is pretty substantial.
It seems that way. Let's get this out of the way early in this conversation. ETF investors will eventually pay a tax bill. Why is it important to control when that happens?
Yeah, so basically you want that money compounding as long as you can before you actually pay the tax bill. So if you take a capital gains distribution this year, for example, you receive that money, you pay taxes on it, then you put it back in a smaller amount. With the ETF, you wouldn't have to pay until you sell it at the end of the day. And so that just allows you to compound it. It's a small return, but over long periods of time, it can be meaningful.
Well, we talked about tax drag. How about cash drag? How are ETFs winning here?
Yeah. So for the same reason, the way that they're structured, where every investor isn't exchanging shares for money with the ETF, they can trade in the secondary market. That means the ETF's trading less, and it doesn't have to, and it can use in-kind creations or redemptions, so that doesn't have to keep cash on hand to avoid selling its holdings. Mutual fund has to keep cash in case there are redemptions. They can pay it out without messing with their strategy at all, with their holdings, with their portfolio. But an ETF can just go, nearly 100% all in on their portfolio without holding any cash.
Now, an ETF's underlying strategy can sharpen or dull the edge it has against a mutual fund when it comes to capital gains. What ETF strategies have held the biggest advantage over the last few years?
So I would say it's going to probably be active ETFs. And the reason is because in general, they're trading more often than passive ones. And I think like a cap weighted index mutual fund won't be trading very often. There's little turnover. And so they sort of just like let the market dictate the weights of the portfolio. So those are limited in their capital gains distributions. So it's really going to be the biggest difference is active ETFs versus active mutual funds.
Can you talk about the tax issues involving international stocks when it comes to managing gains in an ETF?
There's a couple components. Number one being certain countries don't give that advantaged tax treatment for in-kind redemptions. China, India, Brazil, South Korea, South Africa. I'm sure I'm missing a few, but those countries, like when you do an in-kind redemption, those count as realizing capital gains. So in those situations, and then the other one is if there are derivatives, so more typically like currency hedged ETFs, especially a couple of years ago when the dollar appreciated significantly against the yen. Those dollar hedged ETFs gained like 20% based off the currency hedging alone. And with that, those derivatives can't be in-kinded out. Like the currency hedge cannot go through that in-kind process. So it's all cash based. And so those realize capital gains.
And what about taxable bond ETFs versus mutual funds?
So income, not part of the tax advantage of ETFs. So if you think about like high yield bonds or short term bonds, you're not going to find much of an advantage in an ETF wrapper versus a mutual fund in terms of tax efficiency. But if you have something longer duration where you're actually getting capital appreciation, that would still benefit. You would still benefit from having an ETF by not having to realize those capital gains.
So some other exchange traded funds do not benefit from tax efficiency, like you mentioned the taxable bond ETFs. So besides taxable bond ETFs, which investments are those and why don't they?
Yeah. So it's going to be the various derivatives. It's things that you can't move back and forth between an authorized participant. It's certain options, contracts, it's futures, swaps, currency hedging, as an example I already gave. If you gain on those, you're going to have to take those capital gains, or I guess not even capital gains. Take that as like income. They each have their own tax treatment. So in those cases, it doesn't work as well.
So high turnover strategies where there's a lot of buying and selling can result in a big tax bill for investors. What have you found when you compare two momentum strategies?
Yeah, so I looked at two different momentum strategies from Fidelity, one in a mutual fund, one in an ETF. Very similar strategies. But the ETF didn't kick off any capital gains in the mutual fund in 2 of the 3 years I looked at, 2 to 3% in capital gains distributions a year. So very different outcomes from a tax perspective.
And how can outflows leave loyal investors with a hefty tax bill?
It's a problem facing a lot of mutual funds right now. But as outflows come in, it forces the portfolio managers to sell holdings or use, if they run out of their cash on hand, sell holdings and realize capital gains, leads to more capital gains distributions. I think Ben Johnson highlighted in a tweet that there was a mutual fund that's estimating capital gains distributions of something like 75% this year. And I think in large part because of outflows.
How do we find Ben Johnson on Twitter? Because he comes up often at this table, and our listeners and viewers may want to follow him as well.
Absolutely. At MStar Ben Johnson, always a great follow.
Okay.
Highly recommended.
Thank you for the recommendation. So active ETFs popularity is soaring because we talk about this a lot, Bryan. How tax-friendly are these investments against their passive peers and mutual funds?
So far, they've been significantly more tax efficient, and it really depends on the strategy and things around the edges that the ETF PMs can do to make them as tax efficient as possible. But overall, vastly more tax efficient than the mutual funds. I mentioned U.S. equity, 78% versus 7% between ETFs and mutual funds, and that's aggregated. It's beyond active ETFs, but active ETFs are a big part of that. In international, it's similar. It's 46% versus 8%. 46 versus 6%. And so there's a gulf between mutual funds and ETFs. So active ETFs that's one of the main considerations for why you would want to invest in an active ETF over an active mutual fund.
So let's talk about this from a portfolio perspective. Which ETFs belong in a taxable account and which belong in a tax advantage account like a 401k or an IRA to maximize tax efficiency?
Yeah, so ETFs in general in a taxable account is likely to be the most efficient way to approach investing from a tax perspective. If you were considering whether to hold an ETF or a mutual fund in a tax advantage account, in many cases from a tax perspective, it's not a big difference. But in particular for bonds, because so much of income is coming or is taxable at your personal income tax rate, that would be an asset class that you could put in a tax advantage account, and you're going to get the same sort of performance and tax efficiency, whether you're in a tax advantage or taxable account.
Now, what if someone listening or watching just realized that they should work on their asset location? What would you tell them?
Well, consider what capital gains you have embedded in your existing investments. In some ways, that's why you see some of these mutual funds, people not moving to ETFs because they have large gains. They would have to pay a lot in taxes to switch over. So obviously, I would think about whether you're investing in stocks, bonds, by asset class, figure out ETFs for taxable accounts, mutual funds, and things like CITs, great for retirement accounts. But for the most part, I would also just say focus on the strategy, make sure it's what you're looking for, it meets your income needs and your objectives first and foremost.
So what's the takeaway for using ETFs to cut that tax bill?
Use them. Just use the ETFs. Yeah. No, ETFs are extremely tax efficient. I think if we were starting today, a lot of asset managers would launch strategies as ETFs instead of mutual funds. So use it. It's a tool that's at your disposal. We'll see more opportunities with ETF share classes potentially coming out soon. So just in general, if you're adding new money to taxable accounts, go ETFs.
Well, all right. Thank you for coming to the table, Bryan, and discussing how ETFs beat mutual funds at the tax game.
Yeah, thanks for having me.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you. And subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen and associate multimedia editor Jessica Bevel. I'm Ivana Hampton, lead multimedia editor at Morningstar. Take care.